Oil just crossed $100, and the AI trade has a new problem. It is not that demand for artificial intelligence suddenly disappeared. The pressure is traveling through inflation expectations and Treasury yields. That makes future AI profits worth less today, precisely when big tech's build-out is demanding more cash. Reuters reported that Brent crude jumped 8% to $101.76. Official Treasury data then put the 10-year yield at 4.71% on July 23rd, up from 4.67% one day earlier. In the same session, Reuters reported the Nasdaq down about 2.3% as Alphabet and Tesla fell after investors focused on cash use. Oil was not the only cause, but oil, yields and tech weakness exposed the same pressure point. When oil rises this quickly, investors worry that energy costs can keep inflation sticky. That can reduce the Federal Reserve's room to ease and make bond investors demand higher yields. A higher Treasury yield raises the discount rate applied to long-duration assets, including AI companies whose largest expected profits sit years in the future. It can also make data centers, power systems, and the infrastructure around them less forgiving to finance. Alphabet shows why that matters even when AI demand is strong. The company reported second quarter revenue up 24% and cloud revenue up 82%. But it also spent $44.9 billion on capital investment and produced negative free cash flow of $5.9 billion. Alphabet then raised its full-year capital spending range to between $195 and $205 billion. Those numbers do not prove that AI economics are broken. They explain why investors now want faster evidence of cash returns. The AI trade is therefore being tested from two directions. The first is company-specific. Enormous capital spending must turn usage, backlog, and revenue into durable free cash flow. The second is macro. A higher risk-free rate raises the return investors demand even if execution remains strong. Together, they make strong demand only the first half of the proof. Confirmation requires a combination, not one red market session. If Brent holds near $100, the 10-year yield stays around or above 4.7%, and tech breadth remains weak despite strong revenue, the rate shock is still controlling the trade. The thesis weakens if oil quickly loses the spike. The 10-year falls below roughly 4.6%, and Nasdaq breadth improves at the same time. The Federal Reserve meets July 28th and 29th. But no rate decision is guaranteed. The calm verdict is not that AI demand has vanished. It is that the price of funding and the value of time have changed. In a lower yield market, investors could reward the scale of the build-out. Near today's yields, they are demanding proof that the build-out can earn more than its rising cost of capital. Price is surface, but oil, yields, and cash returns are the message.